Tests of controls are audit procedures performed to evaluate whether internal controls have been appropriately designed, implemented, and operated effectively throughout the accounting period. Under ISA 315, identifying and assessing the risks of material misstatement, and ISA 330, the auditor's responses to assessed risks, auditors perform tests of controls when they intend to rely on the effectiveness of the client's internal control system to reduce substantive testing. The objective is to obtain sufficient appropriate audit evidence that controls prevent, detect, or correct material misstatements on a timely basis. Effective controls reduce control risk and improve the reliability of accounting information, whereas deficiencies require auditors to increase substantive procedures and revise the audit strategy. Tests of controls commonly include inquiry, observation, inspection of documents, reperformance, and examination of electronic audit trails to confirm that prescribed control procedures have operated consistently during the reporting period. Modern organizations rely extensively on computerized accounting systems, making computer system controls an essential component of internal control evaluation. Computer controls are generally classified into general IT controls and information processing controls. General IT controls provide the overall framework supporting the integrity and security of information systems and include access security, password management, system development controls, program change controls, backup procedures, disaster recovery planning, and physical security over servers and networks. These controls ensure that information systems operate reliably and that unauthorized access or system failures do not compromise financial reporting. Information processing controls, often referred to as application controls, operate within individual accounting applications and include input controls, processing controls, and output controls that ensure transactions are authorized, complete, accurate, and properly recorded. Effective IT controls strengthen financial reporting reliability and reduce the risk of data manipulation or unauthorized transactions. Within every accounting cycle, auditors evaluate control objectives, control procedures, control activities, and the distinction between direct and indirect controls. Control objectives define what management seeks to achieve, such as transaction completeness, authorization, accuracy, safeguarding of assets, or compliance with company policy. Control procedures and activities represent the specific actions implemented to achieve those objectives, including reconciliations, approvals, segregation of duties, physical safeguards, supervisory reviews, and automated validation checks. Direct controls operate directly over financial transactions, such as authorization of invoices or matching purchase orders to goods received notes, while indirect controls support the overall control environment through governance arrangements, staff training, IT security, and monitoring activities. Auditors evaluate both direct and indirect controls because weaknesses in the overall control environment may reduce the effectiveness of individual transaction controls. The sales system requires controls that ensure revenue is recognized accurately, completely, and only for genuine transactions. Control objectives include preventing unauthorized sales, ensuring proper credit approval, recording all sales completely, and safeguarding receivables. Typical control procedures include sequentially numbered sales orders, authorization of customer credit limits, matching customer orders to dispatch notes and invoices, segregation of sales and receivables functions, and independent reconciliation of receivable ledgers. Auditors test these controls by inspecting documentation, reperforming reconciliations, reviewing authorization signatures, observing order processing procedures, and examining system access controls over sales processing. The purchases system should ensure that purchases are properly authorized, accurately recorded, and made only for legitimate business purposes. Control activities include authorized purchase requisitions, approved supplier lists, sequential purchase orders, matching purchase orders with goods received notes and supplier invoices, segregation of purchasing and payment functions, and independent supplier statement reconciliations. Tests of controls may include inspection of authorization procedures, verification of three-way matching controls, review of supplier reconciliations, observation of goods receipt procedures, and examination of system controls preventing duplicate invoice processing. Effective purchase controls reduce the risk of fictitious purchases, duplicate payments, and unauthorized expenditure. The payroll system contains significant fraud risk due to direct cash payments to employees. Control objectives include ensuring payments are made only to authorized employees for valid work performed and that deductions are accurately calculated. Key controls include personnel authorization for employee appointments, segregation of payroll preparation and payment functions, independent review of payroll calculations, restricted access to payroll master files, approval of overtime, and reconciliation of payroll accounts. Auditors test these controls through inspection of personnel records, reperformance of payroll calculations, observation of payroll processing, review of authorization procedures, and verification of bank transfers to employee accounts. Such controls reduce the risk of ghost employees, unauthorized salary changes, and payroll fraud. The inventory system requires controls over both physical assets and accounting records to ensure accurate valuation and existence. Control objectives include safeguarding inventory against theft, recording all movements accurately, and ensuring inventory is correctly valued in the financial statements. Control activities include sequential goods received notes, perpetual inventory records, authorized inventory movements, restricted warehouse access, periodic inventory counts, and independent reconciliation between physical counts and accounting records. Auditors test inventory controls by observing inventory counts, inspecting count sheets, reviewing authorization of inventory adjustments, examining inventory reconciliations, and evaluating controls over inventory management systems. Strong inventory controls reduce risks associated with theft, obsolescence, and valuation errors. The bank and cash system requires particularly strong controls because cash is highly susceptible to misappropriation. Control objectives include safeguarding cash assets, recording transactions completely, and preventing unauthorized payments. Common controls include segregation of payment authorization and check preparation, dual signatures for significant payments, regular bank reconciliations, restricted online banking access, independent review of reconciliations, and physical security over cash holdings. Auditors test these controls by inspecting reconciliations, observing cash counts, reviewing authorization procedures, reperforming bank reconciliations, and evaluating electronic banking security controls. Effective controls significantly reduce fraud risk and improve cash management reliability. Controls over non-current assets ensure that capital expenditure is properly authorized, accurately recorded, safeguarded against theft, and depreciated appropriately. Control activities include board approval for significant acquisitions, maintenance of fixed asset registers, periodic physical verification, authorization for disposals, and independent review of depreciation calculations. Auditors test these controls by inspecting approval documentation, reconciling asset registers to the general ledger, observing physical assets, reviewing disposal authorization procedures, and reperforming depreciation calculations. Comprehensive evaluation of tests of controls across all business cycles enables auditors to assess control effectiveness, determine reliance on internal controls, and design efficient substantive procedures that support a high-quality, risk-based audit engagement.